Carbon accounting. Principles and practices. Course content. Introduction to carbon accounting. The science behind carbon emissions. Carbon footprinting, concepts and methodologies. Greenhouse gas protocol, scopes 1, 2 and 3. Standards and frameworks in carbon accounting. Carbon accounting in national and international policy. Tools and software for carbon accounting. Sector-specific carbon accounting practices. Verification, auditing, and assurance in carbon accounting. Case studies in carbon accounting. Future trends, AI, blockchain, and real-time monitoring. Part 1. Introduction to carbon accounting. What is carbon accounting? Carbon accounting, also known as greenhouse gas (GHG) accounting, is the process of measuring and tracking greenhouse gas emissions associated with human activities. Just as financial accounting tracks income and expenditures, carbon accounting records the quantity of emissions typically expressed in carbon dioxide equivalents (CO₂e) to help organizations, governments, and individuals understand their climate impact. Carbon accounting provides the foundation for effective climate action. It enables stakeholders to set emission reduction targets, monitor progress, and align with sustainability goals. As the world intensifies efforts to combat climate change, carbon accounting has become an essential tool in the transition to a low-carbon economy. Why carbon accounting matters? Climate change is primarily driven by the accumulation of greenhouse gases in the atmosphere, a direct result of fossil fuel combustion, land use changes, and industrial processes. To mitigate this crisis, it's crucial to quantify these emissions accurately. Key reasons carbon accounting is vital include: transparency provides clear data on emissions, fostering accountability. Target setting enables organizations to set science-based targets. Compliance helps meet regulatory requirements and international agreements like the Paris Agreement. Risk management identifies carbon-related risks and opportunities. Reputation and investor confidence demonstrates commitment to sustainability and attracts responsible investment. Historical context. The concept of carbon accounting emerged in the late 20th century alongside rising environmental awareness. The 1997 Kyoto Protocol was a landmark moment, introducing legally binding targets for GHG emissions. This led to the development of standardized accounting methods, such as the Greenhouse Gas Protocol and ISO 14064, allowing consistent and comparable emissions reporting. Over time, corporate responsibility and environmental, social, and governance (ESG) frameworks expanded the role of carbon accounting. Today, it plays a crucial role in sustainability reporting, green finance, and strategic planning. Who uses carbon accounting? A wide range of stakeholders rely on carbon accounting, including corporations for internal emissions tracking and public sustainability reporting, governments to monitor national emissions and comply with international agreements, investors to assess climate-related risks and opportunities in portfolios, NGOs and civil society to advocate for transparency and accountability, academia and research institutions to study emission trends and inform policy. Key concepts in carbon accounting. To build a solid foundation, here are essential concepts. Carbon dioxide equivalent (CO₂e), a standard unit that expresses the global warming potential of various GHGs in terms of CO. Scopes of emissions, categorization of emissions into Scope 1 direct, Scope 2 indirect from purchased energy, and Scope 3 all other indirect emissions. Emission factors, quantitative values used to estimate emissions from specific activities, e.g., fuel combustion. Carbon footprint, total emissions caused directly and indirectly by an entity or activity. The road ahead. Carbon accounting is more than just a reporting exercise. it's a strategic tool for driving emission reductions, managing risk, and aligning with global climate targets. As technology evolves and regulatory expectations increase, carbon accounting is poised to become more sophisticated, integrated, and impactful. In the following parts, we will explore the science behind emissions, delve into key methodologies, and examine real-world applications across sectors. With a deeper understanding of carbon accounting, we can all play a role in advancing a sustainable net-zero future. Part 2: The science behind carbon emissions. Understanding greenhouse gases (GHGs). Greenhouse gases are atmospheric gases that trap heat, creating the greenhouse effect which warms the Earth. While this natural phenomenon is vital for life, human activities, especially since the Industrial Revolution, have increased GHG concentrations dramatically, intensifying global warming. The main greenhouse gases include carbon dioxide (CO), released from burning fossil fuels, deforestation, and industrial processes; methane (CH), emitted during the production and transport of coal, oil, and natural gas, also from livestock and other agricultural practices; nitrous oxide, dinitrogen monoxide, arises from agricultural activities and industrial processes; fluorinated gases, synthetic gases used in refrigeration, industrial applications, and consumer products. Each gas has a different global warming potential (GWP), measured over a standard time horizon, typically 100 years, and is expressed in terms of CO equivalents (CO₂e) for comparison. The carbon cycle. The carbon cycle describes the continuous movement of carbon among the atmosphere, oceans, soil, and living organisms. It includes natural sources and sinks. Sources: respiration, volcanic activity, natural decay. Sinks: oceans, forests, and soil that absorb more carbon than they emit. Human-induced disruptions. Burning fossil fuels adds carbon to the atmosphere that has been locked away for millions of years. Deforestation reduces the capacity of natural sinks to absorb CO. Disruptions to this cycle have led to a surplus of atmospheric carbon, contributing to the climate crisis. Measuring carbon emissions. Measuring carbon emissions involves quantifying the amount of GHGs produced by specific activities. This is done using direct measurement, using sensors and monitoring equipment, e.g. smokestack measurements. Emission factors, standardized coefficients that estimate emissions from specific activities, e.g. liters of diesel consumed times emission factor. Measurements must be accurate and consistent to inform reliable carbon accounting and decision-making. Carbon dioxide equivalent, CO₂e. Not all greenhouse gases are created equal. To standardize measurement, emissions are expressed in CO₂e. CO₂e. Mass of GHG. Global warming potential, GWP. CO₂e equals mass of GHG times global warming potential, GWP. Example GWPs over 100 years. CO equals 1 baseline. CH approximately equals 28 to 36. NO approximately equals 265 to 298. HFCs and PFCs equals hundreds to thousands. This common metric allows us to aggregate and compare emissions from different sources. Sources of emissions. GHG emissions can be categorized based on their origin. Energy production, the largest source globally, includes power generation and heating. Industry, cement, steel, chemicals, and other manufacturing processes. Transport, road vehicles, aviation, shipping. Buildings, heating, cooling, and lighting. Agriculture, enteric fermentation, manure management, rice cultivation. Land use and forestry, deforestation and land degradation. Understanding sources is essential for effective mitigation strategies. The link to climate change. The accumulation of GHGs leads to climate change, evidenced by rising global temperatures, more frequent and intense weather events, melting glaciers and rising sea levels, shifts in ecosystems and biodiversity. Carbon accounting is a crucial response tool. It quantifies our impact and informs actions to reduce emissions and adapt to a changing climate. The role of science in policy and action. Scientific understanding of carbon and climate dynamics drives international agreements, e.g., the Paris Agreement, national climate policies and emissions targets, carbon markets and pricing mechanisms, corporate sustainability strategies. Science not only informs what needs to be done, but also how progress is measured and verified. Looking ahead. As we transition into the next parts, we'll see how this scientific foundation supports practical carbon accounting methods. Understanding what we emit, where it comes from, and how it contributes to climate change is essential for any credible carbon management strategy. Part 3: Carbon footprinting concepts and methodologies. What is a carbon footprint? A carbon footprint is the total amount of greenhouse gases emitted directly and indirectly by an individual, organization, product, or activity, expressed in carbon dioxide equivalents, CO₂e. It serves as a practical application of carbon accounting, helping quantify environmental impact and identify opportunities for emission reduction. Carbon footprints are used by organizations to manage emissions and sustainability, consumers to make informed lifestyle or product choices, governments to guide policy and climate action, product designers to improve life cycle sustainability. Types of carbon footprints. Carbon footprints can be classified by their scope and focus. Organizational footprint, total emissions from an entity's operations, e.g., a company, university, or city. Product footprint, emissions associated with the life cycle of a product, from raw material extraction to disposal. Event footprint, emissions caused by activities related to a specific event, e.g., a conference or concert. Personal footprint, an individual's or household's emissions from travel, energy use, diet, and consumption. Life cycle assessment, LCA. The life cycle assessment, LCA, is a core methodology used to calculate product carbon footprints. It covers raw material extraction, manufacturing and processing, distribution and retail, use phase, end of life, recycling or disposal. The LCA approach is guided by international standards like ISO 14040 and ISO 14044, ensuring consistency in footprint analysis. Methodologies for carbon footprinting. Several frameworks and protocols are widely used for carbon footprinting. Greenhouse Gas Protocol (GHG Protocol), developed by WRI and WBCSD. The most widely used standard for corporate and product footprints. Divides emissions into scopes 1, 2 and 3, explained in Part 4. Part 2050 UK. A specification for the life cycle GHG emissions of goods and services. ISO 14067. International standard for quantifying and communicating the carbon footprint of products. Bilan Carbone, France. A methodology used mainly in Europe, particularly in France. Each methodology emphasizes traceability, completeness, transparency, and consistency in GHG emission calculations. Emission factors and data sources. Emission factors are essential for estimating GHG emissions from activities. They represent the average emissions for a given activity, e.g., kilogram CO₄e per liter of diesel consumed. Sources of emission factors include IPCC guidelines, national databases, e.g., US EPA, UK DEFRA, industry-specific reports, third-party carbon footprint calculators. Emission data should be up-to-date, regionally accurate, activity-specific. Reliable data ensures trustworthy carbon footprint estimates. Tools and software for carbon footprinting. Numerous digital tools are available to support footprinting activities. OpenLCA for in-depth lifecycle assessments. GHG Protocols Excel tools for corporate emissions. Cool Climate Calculator for personal or small business footprints. Carbon Trust Footprint Calculator. CIMA-Pro Gabi for industrial LCA. These tools allow for transparency, repeatability, and integration into broader sustainability systems. Communicating carbon footprints. Clear communication of carbon footprints is essential to drive change. Formats include carbon labels on products, sustainability reports, carbon disclosures through platforms like CDP, third-party certifications, e.g., carbon neutral, climate neutral. Effective communication builds trust and encourages emission-conscious behavior. Case examples: Apple Inc. publicly shares product carbon footprints and incorporates LCA into product design. IKEA uses footprinting to guide sustainable sourcing and supply chain practices. UN climate conferences measure event footprints and implement offsetting. These examples show how carbon footprinting informs strategic decisions and public accountability. Limitations and challenges. While carbon footprinting is powerful, it faces challenges. Data availability and accuracy. Boundary definition: what's included, excluded. Double counting. Dynamic systems, e.g., changing supply chains. Ongoing improvement in data quality, methods, and technology is helping address these issues. Summary: carbon footprinting is a vital tool in the carbon accounting toolbox. Whether evaluating a product, organization, or personal lifestyle, understanding the emissions profile is the first step towards sustainable choices. With robust methodologies and growing digital support, footprinting is becoming more accessible and actionable. Part 4: Greenhouse Gas Protocol Scopes 1, 2, and 3. Introduction to the GHG Protocol. The Greenhouse Gas (GHG) Protocol is the most widely used international framework for carbon accounting. Developed by the World Resources Institute (WRI) and the World Business Council for Sustainable Development (WBCSD), it provides standards for measuring, managing, and reporting greenhouse gas emissions across organizations, value chains, and products. The protocol's greatest contribution is its classification of emissions into 3 categories: Scope 1, Scope 2, and Scope 3, which enables organizations to clearly define boundaries and responsibilities in emissions reporting. Scope 1 – Direct emissions. Definition: Scope 1 emissions are direct GHG emissions from sources owned or controlled by the reporting organization. Examples: combustion of fuels in company-owned vehicles or equipment. On-site energy generation, e.g., natural gas-fired boilers. Emissions from chemical production in owned facilities. Fugitive emissions, e.g., refrigerant leaks, venting of gases. Key considerations. Scope 1 emissions are typically the easiest to identify and control. They form the baseline for internal efficiency improvements. Scope 2 – Indirect emissions from purchased energy. Definition: Scope 2 emissions are indirect GHG emissions from the generation of purchased electricity, steam, heating, or cooling consumed by the reporting organization. Examples: electricity used to power office buildings, factories, or data centers. Purchased district heating or cooling services. Key considerations. Although emissions occur off-site, they result from the organization's energy use. Scope 2 can be reduced by improving energy efficiency or purchasing renewable energy, e.g., RECs or green tariffs. Dual reporting requirement. The GHG protocol encourages 2 approaches for Scope 2. Location-based method reflects average grid emission factors. Market-based method reflects emissions from purchased energy contracts. Scope 3, other indirect emissions. Definition: Scope 3 emissions are all other indirect emissions that occur in the value chain of the reporting company, both upstream and downstream. Examples: purchased goods and services, business travel and employee commuting, waste disposal, use of sold products, transportation and distribution, investments, leased assets and franchises. Scope 3 is the most comprehensive and often the largest share of an organization's total carbon footprint. GHG Protocol categories for Scope 3, 15 in total. Purchased goods and services, capital goods, fuel and energy-related activities not in Scopes 1 or 2. Upstream transportation and distribution, waste generated in operations, business travel, employee commuting, upstream leased assets, downstream transportation and distribution, processing of sold products, use of sold products, end-of-life treatment of sold products, downstream leased assets, franchises, investments. Key considerations. Scope 3 is difficult to quantify but critical for sustainability strategies. Collaboration with suppliers and customers is often needed. Accurate Scope 3 accounting builds a case for supply chain decarbonization. Emissions boundary setting. Defining the boundary for what emissions to include is essential. The GHG Protocol outlines two main approaches. Equity share approach. Emissions are reported according to the company's share of equity in operations. Control approach. Emissions are reported based on operational or financial control. Choosing the right boundary method ensures consistency and comparability across reporting periods. Relevance of the three scopes. Understanding and reporting emissions across all scopes helps organizations identify hotspots and reduction opportunities, enhance transparency with stakeholders, meet compliance and disclosure requirements, e.g. CDP, SBTi, prepare for carbon pricing and regulation. While Scope 1 and 2 are often prioritized due to their direct impact, Scope 3 provides the full picture and is increasingly emphasized by investors and regulators. Real-world application. Microsoft includes all three scopes in its emissions reporting and has committed to being carbon negative by 2030. Unilever integrates Scope 3 into its supplier engagement programs to drive emissions reductions across the value chain. Amazon has committed to net zero carbon by 2040, with a focus on decarbonizing transport and supply chains, Scope 3 heavy areas. Summary. The GHG Protocol's three-scope model is foundational to carbon accounting. It enables organizations to identify where emissions originate, how they can be measured, and where interventions can be made. As pressure increases to demonstrate climate responsibility, comprehensive emissions reporting across all scopes is not just best practice, it's becoming essential. Part 5: Standards and Frameworks in Carbon Accounting. Importance of standardization in carbon accounting. Carbon accounting relies heavily on standardized frameworks and protocols to ensure consistency, transparency, and comparability across entities and over time. With multiple organizations reporting emissions, often across sectors and geographies, using a common language and methodology is critical to building trust and enabling collective climate action. Standard frameworks guide how emissions are calculated, categorized, and reported, and form the basis for audits, certifications, regulatory compliance, and voluntary disclosures. Key international standards and protocols. 1. Greenhouse Gas (GHG) Protocol. Developed by WRI and WBCSD. Focus: corporate, project, and product level accounting. Structure: corporate standard, project protocol, Product Life Cycle Standard. Scope 3 Standard. Use cases. The most widely adopted framework globally used by corporations, governments and NGOs. 2. ISO 14064 Series. Issued by International Organization for Standardization (ISO). Scope: ISO 14064-1, Quantification and Reporting of GHG Emissions and Removals, Organization Level. ISO 14064-2, GHG Reduction Projects. ISO 14064-3, Verification and Validation of GHG Statements. Key feature: provides structure for third-party audits and certification. 3. ISO 14067. Purpose: quantifying and communicating the carbon footprint of products. Basis: Life Cycle Assessment (LCA) with a focus on climate change impact. Alignment: compatible with ISO 14040 and ISO 14044 LCA standards. 4. PAR 2050. Developed by British Standards Institution (BSI). Focus: product carbon footprinting. Application: used by companies in retail, agriculture and manufacturing. Feature: offers guidelines for assessing the life cycle GHG emissions of goods and services. 5. CDP Carbon Disclosure Project. Nature: voluntary global disclosure system. Participants: over 18,000 companies disclose environmental data annually. Use case: investors and stakeholders use CDP reports for decision-making and benchmarking. 6. Science-Based Targets Initiative (SBTI). Function: provides criteria for setting emissions reduction targets aligned with climate science. Connection: built on the GHG Protocol and aligned with the Paris Agreement. Relevance: widely adopted by corporations to ensure credible climate commitments. 7. Task Force on Climate-Related Financial Disclosures (TCFD). Purpose: framework for reporting climate-related financial risks and opportunities. Key pillars: governance, strategy, risk management, metrics and targets. Status: now being integrated into mandatory regulations in many jurisdictions. National and regional standards. Many countries have their own carbon accounting standards and systems, which often align with or complement international frameworks. India Bureau of Energy Efficiency (B and PAT scheme). EU Emissions Trading System (EU ETS). USA US EPA's GHG reporting program. China carbon trading pilot programs leading to a national ETS. These frameworks often build on ISO or GHG protocol guidance, but include region-specific compliance mechanisms and reporting tools. Frameworks for financial institutions. Financial institutions face unique challenges in carbon accounting, as their emissions are often tied to investments and loans rather than direct operations. Partnership for Carbon Accounting Financials (PCAF). Standard for measuring and disclosing the GHG emissions associated with loans and investments. Enables financial institutions to calculate financed emissions. Net Zero Banking Alliance (NZBA) and Net Zero Asset Managers Initiative (NZAM). Align portfolios with net zero goals. Require robust, science-based carbon accounting for investments. The role of verification and assurance. Standards often require or recommend third-party verification to validate reported emissions. Benefits include increased credibility and trust, reduced risk of errors or greenwashing, enhanced compliance and investor confidence. Accredited verifiers follow ISO 14064-3 or related auditing protocols to ensure integrity and accuracy. The evolving landscape of carbon standards. As climate science advances and regulatory pressure grows, standards continue to evolve. New trends include Integration of climate risk in financial accounting, e.g., ISSB, TCFD to IFRS sustainability standards. Real-time and digital carbon tracking. Harmonization of standards for global comparability. Mandatory climate disclosures. Staying current with these developments is critical for credible and future-ready carbon accounting. Summary. Standards and frameworks are the backbone of carbon accounting. They enable consistent, transparent, and credible emissions measurement across sectors and borders. By aligning with recognized standards, organizations not only meet compliance needs, but also build a strong foundation for climate leadership and innovation. Part 6. Carbon Accounting in National and International Policy. Introduction. Carbon accounting plays a critical role in climate policy at both national and international levels. Accurate and transparent emissions data informs policy design, supports climate targets, and ensures accountability. Without robust carbon accounting systems, it would be impossible to track progress toward climate goals like those set under the Paris Agreement or national net zero pledges. The role of carbon accounting in national climate strategies. Most countries develop nationally determined contributions, NDCs, under the Paris Agreement. These are climate action plans that outline national commitments to reduce emissions. Carbon accounting is used to measure baseline emissions, model emission reduction pathways, track progress toward targets, report transparently to the UNFCCC. These processes are often managed by national agencies and follow international standards to ensure comparability. International frameworks and agreements. 1. United Nations Framework Convention on Climate Change, UNFCCC. Mandate. Requires countries to report their GHG inventories and climate actions. Tools, national communications, biennial reports, and biennial transparency reports. 2. Paris Agreement. Objective. Limit global warming to well below 2 degrees Celsius, preferably 1.5 degrees Celsius. Mechanism. NDCs submitted and updated every 5 years. Article 13. Establishes an enhanced transparency framework, ETF, requiring standardized reporting formats using GHG inventories. 3. IPCC Guidelines. Purpose. Provide consistent methodologies for calculating and reporting national GHG emissions and removals. Additions 1996, 2006, and the 2019 refinement. Countries are expected to follow these guidelines when preparing national emissions inventories. National greenhouse gas inventories. GHG inventories are comprehensive datasets that quantify emissions by source and sector. They are prepared using activity data, e.g., fuel consumption, livestock numbers. Emission factors, based on IPCC or country-specific data. Key sectors covered: energy, industrial processes, agriculture, waste, land use change and forestry, LULUCF. Many developed countries use tiered methodologies, from basic Tier 1 to highly detailed Tier 3, depending on data availability and technical capacity. Emissions trading schemes, ETS, and carbon markets. Carbon accounting is the backbone of cap-and-trade systems and carbon credit markets. Without accurate accounting, these mechanisms would lack integrity. Examples of ETS. EU Emissions Trading System, EU ETS, world's largest carbon market. California Cap-and-Trade Program. China's national ETS focuses initially on the power sector. Key accounting needs for ETS. Monitoring, reporting, and verification (MRV) of emissions. Registry systems to track allowances. Compliance reporting and auditing. Carbon accounting in voluntary carbon markets. Voluntary carbon markets, VCMs, allow entities to offset emissions by purchasing carbon credits generated through verified mitigation projects. Key elements: carbon credit standards, e.g., Verified Carbon Standard (VCS) Gold Standard. Third-party verification. Registry platforms, e.g., Verra Climate Action Reserve. Accounting principles ensure no double counting. Additionality. Emissions reductions wouldn't happen without the project. Permanence and transparency. Nationally appropriate mitigation actions, NAMAs. NAMAs are voluntary actions taken by developing countries to reduce emissions, often with support from international funding. Carbon accounting ensures clear baselines, transparent measurement of outcomes, reporting to donors and stakeholders. While the term NAMA is being phased out post-Paris Agreement, similar initiatives continue under climate finance frameworks. Role of carbon accounting in climate finance. Donor countries and climate funds require robust carbon accounting for evaluating project proposals, measuring impact, avoiding double counting of emission reductions, ensuring transparency in results-based finance. Climate finance mechanisms. Green Climate Fund (GCF), Global Environment Facility (GEF), Carbon Offset and Reduction Scheme for International Aviation (CORSIA). Emerging trends in policy-level carbon accounting. Digital MRV systems, real-time monitoring and blockchain-based registries. Carbon Border Adjustment Mechanisms (CBAMs) require product-level emission accounting for cross-border trade. Integration with financial reporting, mandates under frameworks like TCFD and IFRS sustainability standards. Nature-based solutions accounting, enhanced tracking of carbon sequestration in forests, wetlands and soils. Summary. Carbon accounting is foundational to effective climate policy and global collaboration. Whether informing national strategies, supporting emissions trading or enabling climate finance, robust accounting systems help bridge ambition with action. As international frameworks become more rigorous and technology more sophisticated, carbon accounting will only grow in importance as a driver of climate integrity and impact. Part 7. Tools and Technologies for Carbon Accounting. Introduction. As carbon accounting becomes more sophisticated and widespread, digital tools and technologies are playing a crucial role in simplifying data collection, improving accuracy, and automating reporting. Organizations from small businesses to global conglomerates are increasingly leveraging software platforms, IoT devices, and data analytics to track, manage, and reduce their carbon footprints efficiently. Categories of carbon accounting tools. Carbon accounting tools can be grouped into the following categories. Enterprise carbon accounting software. Lifecycle assessment (LCA) tools. Carbon footprint calculators. Emission factor databases. Blockchain and digital MRV platforms. IoT and sensor-based monitoring. Each category addresses different scales and scopes of carbon tracking. Enterprise carbon accounting software. These platforms are designed to help organizations collect, analyze, and report GHG emissions across scopes 1, 2, and 3. Key features. Automated data collection from utility bills, ERP systems and supply chains. Built-in emission factors and calculators. Dashboards and analytics. Integration with reporting standards, GHG Protocol CDP TCFD. Popular platforms. Sustain Life, Persephone, Watershed, NVC IBM, Microsoft Cloud for sustainability. SAP Sustainability Control Tower. These tools are often cloud-based and offer APIs for easy integration with existing business systems. Lifecycle assessment (LCA) tools. LCA tools assess the environmental impact, including carbon emissions, of a product or service over its entire life cycle, from raw material extraction to disposal. Applications: product design and eco-labeling, Scope 3 emissions accounting, circular economy strategy. Examples: SEMA Pro, OpenLCA, Gabi software. EcoInvent, database used in conjunction with LCA tools. These tools help manufacturers and product designers make data-driven decisions to reduce carbon intensity. Carbon footprint calculators. These are simplified tools designed for individuals or small organizations to estimate their carbon emissions. Features: input-based estimation, e.g., electricity use, travel habits, food consumption. Comparative analysis and recommendations, often used in awareness campaigns. Examples: WWF Footprint Calculator, Cool Climate Calculator, UC Berkeley. Carbon Footprint Limited. While less precise, these tools are accessible and effective in promoting behavioral change. Emission factor databases. Emission factors convert activity data, like liters of fuel used or kilowatt-hours of electricity consumed, into carbon emissions. Reliable databases are crucial for accurate calculations. Key sources: IPCC Emission Factor Database, DEFRA, UK Department for Environment, Food and Rural Affairs, EPA Emissions Factors Hub, USA, IEA International Energy Agency. Modern software often integrates these databases to automatically apply the correct factors during calculations. Blockchain and digital MRV platforms. Emerging digital platforms use blockchain to enhance transparency, traceability, and trust in carbon accounting, especially in carbon markets. Applications: digital carbon credits, avoiding double counting, smart contracts for automated verification and payments. Platforms: Token Protocol, ClimaDAO, Carbon Place, Verra and Gold Standard digital registries. These technologies are rapidly evolving and being tested in pilot projects and voluntary markets. Internet of Things (IoT) and sensor technologies. IoT devices collect real-time emissions data from machinery, vehicles, buildings, and industrial processes, making carbon accounting more dynamic and accurate. Use cases: monitoring fuel combustion in real time, energy consumption tracking in buildings, automated emissions logging in manufacturing. Benefits: reduces manual data entry, enables predictive analytics, supports continuous improvement strategies, artificial intelligence and big data analytics. AI and machine learning are being used to predict emission trends, optimize operations for emissions reduction, automate anomaly detection, identify supply chain risks. Example: AI-driven supply chain platforms can identify emission hotspots and recommend low-carbon alternatives. Challenges in technology adoption. Despite the advantages, organizations may face high upfront costs, data privacy and cybersecurity concerns, interoperability issues, lack of standardization across platforms. To overcome these, businesses are advised to start with scalable solutions, integrate carbon tools with existing ERP and ESG systems, train staff and allocate sustainability budgets. Future outlook. Technologies in carbon accounting are evolving toward real-time automated carbon ledgers, integration with financial reporting and ESG tools, digital twins for emissions modeling, decentralized platforms for stakeholder collaboration. Governments, investors, and consumers will increasingly demand data-driven transparency, pushing carbon accounting technology to become a core business function. Summary: technology is transforming carbon accounting from a compliance task into a strategic opportunity. By adopting the right tools, organizations can streamline reporting, improve accuracy, and accelerate their decarbonization journey. As digital innovation continues, carbon accounting will become smarter, faster, and more integrated into everyday decision-making. Part 8. Sector-specific carbon accounting practices. Introduction. While the principles of carbon accounting remain consistent across sectors, each industry has unique emission sources, accounting complexities, and reporting requirements. Understanding sector-specific practices is essential to ensure accuracy, compliance, and effectiveness in climate strategies. This part explores how carbon accounting is applied across key sectors, with emphasis on their specific emission sources, standards, and challenges. Energy sector. Key emission sources: combustion of fossil fuels, coal, oil, natural gas. Methane leakage from extraction and transportation. Flaring and venting. Carbon accounting approaches: direct measurement using sensors and continuous emissions monitoring systems, CEMS. Use of standard emission factors based on fuel type and quantity. Life cycle emissions for power generation, well-to-wire. Reporting standards. IPCC guidelines. GHG protocol, energy sector guidance. ISO 14064. Challenges. Fugitive emissions tracking. Carbon capture and storage accounting. Transitioning from fossil-based baselines to renewables. Transportation sector. Key emission sources: fuel combustion from road, air, maritime, and rail transport. Manufacturing and end of life of vehicles. Indirect emissions from infrastructure, e.g. airports, roads. Carbon accounting practices: fuel-based calculation methods, liters, gallons consumed times emission factor. Vehicle-specific emission data, grams CO per kilometer. Scope 3 accounting for supply chain and product use phase. Tools and standards. DEFRA transport emission factors. ICAO and IMO guidelines for aviation and shipping. Smart Freight Centers GLEC framework. Challenges. Tracking logistics-related Scope 3 emissions. Electrification impact and grid intensity variations. Lack of standardization in multimodal emissions reporting. Industrial and manufacturing sector. Key emission sources: fuel use in production processes. Industrial chemical reactions, e.g. cement, steel, aluminum. Use of refrigerants and solvents. Carbon accounting practices: process-based accounting using activity data and emission coefficients. Direct measurements for large emitters. Life cycle analysis for products. Standards and guidelines. GHG protocol corporate and Scope 3 standards. ISO 14067 for product carbon footprints. Industry-specific benchmarks, e.g. cement, CSI Cement Sustainability Initiative. Challenges. Scope 3 emissions in global supply chains. Emission-intensive inputs, raw materials, energy. Accounting for circular economy and recycling impacts. Agriculture, forestry, and land use, AFOLU. Key emission sources: livestock enteric fermentation and manure. Rice cultivation and fertilizer application. Deforestation and land use change. Soil carbon loss. Accounting approaches. IPCC tiered methodologies, Tier 1 to 3. Remote sensing for land use tracking. Carbon sequestration accounting in forestry and regenerative agriculture. Standards. IPCC guidelines for AFOLU. FAO's XACT tool. Verified Carbon Standard, VCS for nature-based solutions. Challenges. high variability and uncertainty, long timeframes for land use changes, leakage and permanence in forestry projects, buildings and construction, key emission sources, operational energy use, heating, cooling, lighting, embodied carbon in materials, concrete, steel, glass, construction machinery and transport, carbon accounting practices, energy modeling tools, e.g., EnergyPlus RET screen, LCA for materials and full building life cycle, building information modeling BIM integration, frameworks and certifications, LEED BREEAM Well Edge, GHG Protocol Scope 1 and 2 reporting, N15978 standard for whole life carbon. Challenges: lack of data on material supply chains, split incentives in rented buildings, variability in energy performance post-occupancy, financial sector, key emission categories, operational emissions, offices, travel, financed emissions from investments and loans, Scope 3, Category 15, accounting tools, Partnership for Carbon Accounting Financials, PCAF, SBTI for financial institutions, TCFD aligned risk and opportunity disclosure. Challenges: access to borrower or portfolio company data, double counting between institutions, integration of carbon data into financial risk models, retail and consumer goods, key emission sources, product manufacturing and packaging, distribution logistics, product use and disposal, Scope 3, carbon accounting practices, product carbon footprinting, PCF, supply chain assessments, retail energy use and waste tracking, frameworks, GHG Protocol Product Standard, ISO 14067, PAR 2050. Challenges: vast complex supply chains, consumer behavior's influence on emissions, brand transparency and greenwashing risks. Summary: each sector has unique emissions profiles and corresponding accounting needs. By tailoring carbon accounting practices to sector-specific realities, organizations can more effectively identify emission hotspots, comply with regulations, and target mitigation strategies. A one-size-fits-all approach is insufficient. Granularity, customization, and industry collaboration are essential to accurate carbon accounting. Part 9: Verification, Auditing, and Assurance in Carbon Accounting. Introduction. As carbon accounting becomes a cornerstone of sustainability reporting, stakeholders increasingly demand transparency, credibility, and accuracy. Verification, auditing, and assurance processes help ensure that carbon data and disclosures are trustworthy and in line with international standards. These processes are crucial for building confidence among regulators, investors, customers, and the public. Definitions and key concepts.